and welcome. You're tuned into Closing Trades right here on ET Now, and you are catching us live from SBI Live Studios. And taking a look at the markets, we are seen to be drifting lower, but all throughout the day, it's been a range-bound trading session all in all for the markets. But for now, Nifty Bank is also now turned into the red territory, almost 80 points of cut over there, almost 100 points of decline coming in on the Nifty 50. And as we know that it's the IT pack, that's the biggest spoiled spot today. And even the declines on the IT pack is getting sharper tick by tick. Tech Mahindra, TCS, Infosys, Wipro, HCL Tech, these are your top 5 drags on the Nifty 50 side. But on the flip side, that's very interesting to note is that the Adani Group of counters have come at the forefront and tried to lend some support to the market. So we were discussing in the morning itself that if the tech-heavy majors are seen to be taking a bit of a backseat, which sector or segment rather will emerge, and that's clearly the Adani Group of counters. Other than that, some of these themes which have been doing very well, case in point being the new age tech companies. Other than that, the life insurance companies, they are once again seen to be lending support for the markets right now, and we can't complain much when it comes to the breadth of the market in terms of the advance and decline ratio. It's a bit of a tussle that is going over there, but yes, the number of stocks that are seen to be declining is higher in number versus the advances. But Snehi, what are you spotting right now?
Shrishti, what I'm spotting is not looking all that good, because once again almost a 100-point cut, and in fact a 100-point cut coming in on the Nifty 50 right now, 0.4% lower, and we seem to be falling further from those levels as well. Sensex 0.5% lower. It's actually India Wix a 4% uptick, and this is something that we've seen after quite a while for India Wix. So at least some movement over there. Nifty Bank too, not as low as the benchmarks, but still almost a 0.2% cut in the red is what the Nifty Bank is seeing. And Shashti, like you were highlighting some Adani Group of stocks, all eyes are actually on Adani Power today, locked an upper circuit of 20% as we speak. Remember, 1:5 stock split is something that we've seen on the stock today, and the stock is trading X stock split. Other than that, we have reports saying GQG has sold some Adani Power shares to SBI Mutual Fund and some other buyers amid this stock split. So on the back of that, Adani Power 20% upper circuit is what we're seeing. And ever since that SEBI clearance on the Hindenburg allegation has come from the on the Adani Group of stocks, they have been on the tear. Adani Power was the top Adani Group gainer on Friday as well, continues to move that trend ahead. And you also have Adani Enterprises Ports from the Adani Group doing well. But let's take it across to my colleague Aisha, who's joining us live from the JP Morgan 10th Annual Conference. Aisha.
Well, thanks for that. And we're almost closing down on day one at the JP Morgan conference here in Mumbai. And who better than James Sullivan himself right here with us to give us some color on how day one has been and what's lined up for day two as well. James, welcome to ET Now. Quite intrigued to know what are the questions about India. There's so much push and pull happening with us at both ends.
No, as you very rightly say, I think it's a very unique time to be looking at the Indian market for a couple different reasons. On the macroeconomic side, there are statistics really pointing in both directions. From a markets perspective, though, I think the outlook is a little bit clearer. The nice thing about markets is ultimately it's about pricing in various versions of the future. At the moment, because of significant market underperformance relative to the rest of Asia, because of currency underperformance, but also critically, as we were discussing prior to the program, the fact that earnings expectations have been significantly reduced, we're at a stage where we think entering the Indian market from an equity perspective right now makes a lot of sense. The risks are skewed, we would argue, asymmetrically to the upside because expectations have been lowered significantly.
But is the tariff disruption in the price?
Look, I think it is. If you look at how the tariff disruption potentially filters through the Indian economy, there's a couple of things to think about. So the headline is 50%. If you adjust for excluded items, however, you're sitting at 34, which is still a relatively high number, but not nearly as high as the headline. And then if you look at the opportunity for Indian companies to diversify and relocate those exports over time, we do think that the economy has the ability to adjust and to stomach some of the impact. The other reality, however, though, is that the Indian economy is far less exposed to export as a driver of the overall economy, at least on the good side, relative to most of the rest of Asia. And so on a relative basis, if we're trying to understand the impact, India actually looks reasonably good because goods exports are not the driver of the economy. It's really been the services side that has been most interesting.
And you see existing services getting interrupted because of the recent visa fee hike?
I would look at it a little bit the opposite way, actually. I mean, if you think about it very, very simplistically, you've had 2 decades where foreign companies have hired Indians and moved them to the U.S. Now they'll hire Indians and leave them here in India, right? Like JP Morgan has 20,000 people here in India. And so the argument that this fundamentally changes the nature of the services conversation in India, I disagree with. It might change some element of the exportation of services, but if that requires more Indians hired and left on shore, that's not necessarily bad for anybody.
That's a model for anyone to look at, U.S. companies and others?
So 2 components to my answer. Number one, the idea that the world will continue to leverage India as the office of the world, I think, is still a very compelling conversation and drives a lot of investor interest in this market. The other side of the equation is the devil is always in the details, and at the moment we have almost no details in terms of the implementation of this policy in the United States. And so we'll have to see how this actually rolls out in practice versus in tweet or headline. But the overall message is that we think that India as the office of the world is still a very compelling thematic moving forward.
James, as this disruption plays out, either where Indian companies set up shop in the U.S. or a lot of the Indian workers who were in the U.S. set up shop back here, that disruption is going to come at a cost. And that's something that the equity markets would have to factor in a jiffy.
Yes.
So if I'm building an India portfolio right now, what should be my sector, overweights, underweights,
Sure.
So much flux, how do I price that all in?
Sure, I think so. The easiest way to construct an overall India-focused portfolio right now, at least from a JP Morgan perspective, is to really key into demand that is driven by domestic forces and storylines that are more under control of the Indian government or Indian corporates than exposed to international decisions over which we don't know what's going to happen. And so if we think about the fact that we just saw a very good second quarter calendar year, first quarter fiscal year here in India, GDP print at 7.8%. JP Morgan's taken up our full year economic growth forecast off that print. Monsoon, as we can see outside today, doing quite well, 7% ahead of historical averages.
Stretch there, stay.
Exactly. Well, you never know. That plus the typhoon in Hong Kong, people might be here for a while. The point, though, is that you see multiple drivers of incremental demand, particularly in rural India, which is a core line of analysis that we've continued to focus on. So you have a combination of a better-than-expected monsoon, reasonably good macroeconomic backdrop, paired or tripled with the GST rate cut that the government just pushed through. You have multiple idiosyncratic drivers of rural demand, consumption demand here in India that have nothing to do with the broader trade conversation. And so really keying into those sectors, so consumer staples, consumer discretionary, financial services is something that we've been very focused on.
The foreign flows, which are actually a negative for us.
Yes.
And you've listed a lot of positives which are coming in with respect to consumption, with respect to the models that could go for services and others. When do you think global funds are going to look at India as one of the countries?
Great question, and they haven't been slightly negative. They've been $23 billion negative
yeah.
for FIIs over the course of the last 12 months, and so that's a big number. The critical element from our perspective is always watch where the market starts. And if I look at Asian market performance this year, you have India being a dramatic underperformer after relative periods of outperformance historically. You have the Korean market up 50% after a truly abysmal 2024. And so that starting point is absolutely critical. And so you've seen the sell down by foreign investors. Why did that occur? You had a confluence of India becoming relatively expensive relative to regional and global peers at the same time that you saw a stalling out in terms of earnings forecast revision. And so we had actually downgraded the Indian market too early, in hindsight, off the back of that downward revision in corporate earnings. Now that revision cycle, we feel, has bottomed. And so the street's already sold. Valuations are now regionally attractive. Earnings expectations are imminently beatable, which is a very strong setup for incremental performance.
So if you look at the valuation, the relative valuation has remained the same. It's the Asian valuations which have gone up, right?
Exactly.
In that sense. So from a foreign investor's point of view, how do you look at this entire thing? Even if India is underperforming the Asian markets in that?
So the valuation conversation in India is a slightly longer one, but I think the fascinating aspect of it, ultimately valuations are premised in the value of money. And the differential conversation here in India relative to a lot of markets around the world is the fact that you're seeing a structural reduction in the cost of money in India as interest rates have started to structurally come down. And we had the deputy RBI governor on stage talking about this earlier. That arguably sets the stage for a higher overall valuation metric here in India. And so one of the things that we caution investors about a lot is now relative to 10-year historical average, I don't really care, because that average was based on a set of macroeconomic and microeconomic statistics which may or may not be relevant today. And so if I look at India's relative valuation to the US, to other markets around the world where you're seeing rate structures go up versus rate structures here go down, that absolutely matters in terms of those relative valuations.
The domestic flows is playing a big important role, and
Absolutely.
it's not allowing your valuations to come down either, right?
Absolutely, and so you've seen $23 billion in FII outflows. You've seen, I think it's $93 billion in inflows.
Yeah.
Now, why isn't the market up off of that differential? Because a lot of that has been soaked up by new issuance. But again, that's a very positive side for the Indian economy. It's a very positive sign for the maturation of Indian equity markets as the broader segment of the Indian population starts to participate and really benefit from the upside in the overall market.
But James, if I were to just sort of zoom out of India and look at the whole globe as a picture, you think the trump card, and no pun intended here, lies in the way the dollar is going to move? Or is it going to be more about Fed action?
So they're interlinked by definition. I think if we take a step back here in Asia for a second, one thing that we haven't talked about is there is a reality in Asian markets where it is very, very rare for both India and China equity markets to work at the same time. And so one of the dynamics that we very frequently see is this rotational trade within Asia. The reality is China got very cheap. You started to see positive earnings revisions. You started to see policy impetus across a range of sectors that has driven significant outperformance for Hong Kong, China, A, H, et cetera. Now, to some degree, that comes at the expense of India, as you saw this rotational trade kicking in. Now we're at a situation where China has outperformed, India's underperformed, expectations have gone up, expectations have come down. Again, one of the things I love about my job is this search for asymmetry. And we really feel that that's starting to come to the fore here in India right now.
And how exchange-traded funds have been investing into China, Korea, and other Asian countries. Do you see a reversal of trade happening at that?
We'll have to see. From a broader asset allocation perspective, one of the key dynamics that we see on the ETF side is really this dynamic where ETF fund flow comes into a market, and this has been true here in India as well, and it effectively floats the top end of the market away. And so if you look at the valuation gap between large caps and mid and small caps in a lot of Asian markets right now, that's gapped out because of the ETF flows. The dynamic that we pay attention to here in India is from a research coverage perspective, we're seeing a significant broadening of investor interest past the mega caps and into the mid and small cap space. And so we're expanding coverage here in India. We're actually making 2 offers this week for incremental analyst hires and continuing to invest in this market.
Confused by the
Studio, and while we're talking about the texture of the market, it's not looking optimistic at all because we continue to fall 24,217. In fact, okay, we have slipped below that 25,200 mark too, so that's a sharp cut coming in from the day's high coming in. 0.5% cut over there. Cut has intensified, pardon me, on Sensex as well. India VIX up 6%. Now, Kunal, this spike in India VIX, remember, just last week we were in fact talking about how the India VIX has been absolutely stagnant, not moving at all. And today, this H1B news flow is all it took for India VIX to finally show a spike up.
Yeah, so I think today it's on the back of news flow, and the VIX has to rise generally when the sentiment suddenly gets spooked, and that spooking of sentiment happens when there is news flow which is attached. It doesn't happen on a very a market which is devoid of news flows or any kind of a major events. So I think in that aspect, today's rise in the VIX gets justified. But then I think the movement of the markets today, this down 150 odd points for the Nifty, is not just on the back of the rise in the India VIX. It's also, I think, some underperformance which has come out from sectors like financials or banking, specifically in private sector banking names. I think that's a sector which is underperformed. So we were discussing this in the morning that if the markets have to balance out, then if IT sector opens with a gap down opening, you might have other sectors trying to play the lead and trying to at least cover up the underperformance which could be there. But that that part was played for the first half, where you saw the Bank Nifty remaining about that 55,700, 600 plus mark. But then I think from the second half itself, we saw some selling pressure which come back into the private sector banking names specifically. So I think maybe the markets are just about indicative that we are not heading towards any kind of a major breakdown or breakout or breakdown as such. And we could just about trade into this 500-point band for the Nifty, 25,000, 25,050 as a support, and 25,500 broadly as a resistance for the index still remains.
All right, so if at all we are off the day's highest point, that is indeed what we are getting to see. But along with that, the markets are expected to be quite range bound, is what Kunal is highlighting. But with this, let me also welcome on board Ruchit Jain on the show right now. Hi Ruchit, good afternoon. And what do you make of the markets, Ruchit? Because it's a bit of a U-turn by the markets, but along with that, heavyweights like Reliance and HDFC Bank, they are also down.
Yeah, hi,
in
very
trade
good
right
afternoon.
now.
Yes, hi, very good afternoon. We have seen a good run-up in last 3 weeks in the market from the lows. If you look at the Nifty index itself, then a move from 24,400 to 25. It was seen without any pullback or correction. So I think the things on the low bit overbought zone, and this is leading to this pullback move that we are witnessing. While this does not change the immediate trend for the market, but no, definitely indications are that some sort of short-term pullback is there in the market. So we are advising traders to keep a buy and dip approach, and any decline towards the 25,100, 25,050 range, would be a good support to watch out for. So I think this is just a correction within an uptrend, and any declines towards the support, whether in Nifty as well as in Bank Nifty, should be used as a buying opportunity.
Okay, so buy on dips, and those are the levels to watch out for. That's the word coming in from Ruchit. But on that note, we'll slip into a very short break and be back for more on the other side. To head and the kind of cuts that we've seen in the market today. We have Kunal and Ruchit both back with us. But Kunal, let me first come to you and let's talk about sectors. Now, not much in the green right now, but at one point of the day, you did have the entire real estate pack that was holding on to the shade of green and doing very well for itself on the back of this GCC opportunity that we're hearing now that a lot of tech jobs could be moving back home. What's your take on real estate and particularly Anantraj as a stock? Because remember last week when that data center boost came from the government, the stock was up, and today yet again.
Yeah, so I think Anantraj is a different league altogether now because it's not just about real estate. I think the stock has diversified itself. So I think in that sense, it's just charging a lot of premium, and the power performance over the last couple of days has been very, very stellar for Anantraj. And I think this was also due in some aspect for the stock price. Because I think the correction which happened for Anantraj, if I'm not wrong, 800 or 900 was the high for the stock in 2024, and from there the stock had fallen down to almost 40-50%. So somehow the stock, which was a very high beta stock and had a tendency of participating very well with respect to the overall market trends over the last many years, that was a missing feature for the stock price. So it's just trying to get back into the alignment. And if I can just put maybe one more example, the Adani Group of stocks. Even these stocks were out of sync for the last many months with respect to the overall market. So I think now the flavor is coming back for the markets with respect to these two interesting pockets. Yes, I think in terms of sectors, real estate space definitely looks very attractive even at current levels. The only catch over here is that there are many of the stocks which are still trading below their long-term averages. I was actually looking at the charts for DLF, Oberoi Realty, etc. I think many of these stocks are still trading below their long-term averages. So when you have such a kind of a setup where there is a base building which is happening, but these stocks are still reeling below their longer-term averages, you have to take it step by step. Initially we look at say 50 DMAs or 200 DMAs as the first set of targets for the stock prices, and then based on the volume patterns, the urgency of the stock prices moving above those key averages, that's where we determine that whether we are looking at a major trend building or not. So as of now, I would look at maybe a phase one of the market of the rally for the real estate stocks. DLF, Prestige, Oberoi Realty are the three names which fit in that category.
All right, that's the take coming in on the real estate counters. Let's watch out for that. But with this, let's also get you some of the tradable ideas from both of our experts. And Ruchit, you go first. Tell us which is the BTST or STBT idea you have for our viewers.
A couple of names that we like in such market where our performance could be seen. First is Adani Group stock, Adani Ports, where we have seen in last couple of trading sessions, the entire group has witnessed good price volume action. Adani Port is one stock which is quite close to its 52-week high, indicating that in the recent past as well, when the entire group has shown a related underperformance, the stock has shown a good relative strength. So I think Adani Ports is one stock where the risk-reward ratio is still favorable at current levels. I would recommend to go long with stop loss below 1420. And if we see an upside in the near term, that it could rally even towards 1550 in the short term. I think Adani Ports is one stock which we would recommend, and Bank of Baroda is my second recommendation over here. So primarily the entire PSU banking space, if you see after a consolidation of about 3 months, have seen a good breakout in last 3 or 4 trading sessions. Bank of Baroda also, whenever it was coming around 248, 250, it was witnessing selling pressure. But that range has been broken out on the upside. So we are quite constructive on the PSU banking space from a trading perspective, within which Bank of Baroda is good on charts. So one can go long there too, keeping stop loss below 242 for potential targets around 267.
So Adani Ports and Bank of Baroda, two stocks looking good to Rajit right now. Kunal, what about you? What's looking appealing in a market that's largely falling?
See, I think in this kind of a market, it is very important as a strategy to lower the beta of the stocks which one is looking at in terms of buying. So in that aspect, I would suggest to buy calls and large cap names which are low beta. The first one is ONGC. That's a chart which is looking attractive. The stock is heading towards a breakout, I think, of a 50-day moving average. If I'm not wrong, this is a breakout. This could be a breakout potentially if the stock closes above the 50 DMA after almost 2 or 3 months of the stock trading below this key medium-term moving average. So that, I believe, could be interesting feature for a stock like ONGC. Would look out for targets in the range of at least 243. Stop loss could be kept at 235. And the second would be a buy on Grasim. In a very similar vein, I think Grasim is also showing signs of a potential breakout on the short-term consolidation charts. The breakout point is closer to that 2,885, 890. So if the stock happens to cross back about 2,885 and closes above this level, that's where I would suggest the buy could be triggered for Grasim. Look out for targets in the range of 3,000 and stop loss could be kept at 2830.
All right, so those are the buy calls coming in from both of our experts. Let's watch out for that. But along with that, one of the pockets that has done very well is actually the Adani Group of counters, wherein you see majorly all the stocks are on fire today. And that's made a buzz as reports suggest that GQG has sold Adani Power shares to SBI Fund and Citadel Securities. My colleague Rabinder joins in with more details on the Adani Group of counters. Rabinder.
Well, as entire Adani Group stock is in focus on the past few sessions, and there are many key triggers for this rally. First is GQG has sold Adani Power shares to SBI Fund Citadel Security worth of USD 250 million last week, and there are a few growth triggers for the Adani Group's companies going ahead. First is Adani Group debt to EBITDA ratio at group level has come down from the past few times, and India rating agencies has upgraded the Adani Group stocks, and Hindenburg case has overhang has done, and access to longer tenure cheaper capital would be there, and the strong revenue profit the company's Adani Group has a strong revenue profitability for next 25 to 50 years, and all sectors of the Adani Group's company are linked to infrastructure, and India's infra story is long way to go ahead. And if we talk about to debt to service coverage ratio for Adani Group, then in FY25 it was 2.5, FY24 was also it was 2.5, and for FY25 it came to at 2.6, and in Q1 FY26 it came at 1.8. And if we talk about the stock performance of the Adani Groups in last 2 days, then the Adani Total Gas was up by 24%, and Adani Green was 13, and Adani Enterprise stock was up by 8% in the past 2 trading sessions. And if we talk about the capex plan of the Adani Group's company, talking about the Adani Enterprise, then Adani Enterprise capex plan is 31,838 crore, and for Adani Port it is 8,350. And if we talk about the group levels capex of the Adani Group, then the Adani Group has a capex plan of 15 to 20 billion dollar for next 5 years. And if we talk about the 12-month return potential of the Adani Group's company, for Adani Ports the target price is 1,708 with return potential of 18%. For Adani Enterprise it is 3,000 with return potential of 14%. For ACC 2,127 target price, and for Adani Power it is 141 with return potential of minus 17%.
Ravinder, thanks for taking us through that. So the Adani Group stocks are in focus, like Ravinder was mentioning. Big gains coming in on Adani Power, Adani Total, Adani Green, all of these, and of course Adani Energy Solutions as well. All of them looking very good. Anywhere between 7% and 20% upper circuit is what we're seeing on some of these stocks. But let's take the market conversation ahead, get a check of where the markets are headed, what is looking good, and mainly what should your navigation strategy be amid a volatile market like this. We have Mayuresh Joshi, Head of Equity at MarketSmith India, also joining us on the show. And Mayuresh, hi, good afternoon, and thanks for your time today. And give us a sense of just that, right? The kind of volatility that we have once again seeing seeping in the market right now, given the kind of sector churn we've seen, of course, our viewers or anybody rather would be tempted to buy given the fall we've seen. But which sectors are looking good right now, and how do you gauge where the sector churn could be headed next?
Very good afternoon. Now, again, I think the entire emphasis will be on consumption and growth. So I think both the engines in terms of the GST rationalization moves that have largely taken place would reflect in better volumes happening across both consumer durables as well as consumer discretionary. And at the same time, the government capex, along with private capex, which has seen green shoots of coming back, would largely mean that growth capital might be required for a whole host of domestic projects as far as manufacturing or infrastructure growth is concerned. Therefore, we remain extremely optimistic in terms of quite a few segments within all these spaces that can continue doing well. Within consumption as a basket, our own sense is hotels as a space should continue doing well. FMCG selectively, where volume stroke value growth should emerge very, very strongly, should emerge as a very strong earnings contender where earnings should come back very, very strongly as we start hitting Q3. Within the sub-segments of consumption, footwear and domestic apparel makers might actually continue doing well. Since infrastructure manufacturing, because of private and public capex, might be also something on the agenda, I think select NBFCs can continue doing well, in our opinion. For infrastructure and manufacturing, I think the sub-segments like cement, where the expectations of reasonable volume growth coming through, consolidation that we've probably seen for the industry itself will mean better dynamics as far as pricing is concerned, because of a lot of cost efficiencies built in because of internal power, captive power uses as waste heat recovery plants as well, along with more sanguine logistic requirements that have got built in, along with cheaper input costs. Reported EBITDA and EBITDA per ton as we head into Q3 will be relatively better. So in our own sense, I think selective sectors, as I mentioned, can continue doing well. And again, I think the entire focus in terms of both consumption and investments coming back might actually propel earnings to probably hold up as we begin Q3. Therefore, from a market standpoint, as we see it in MarketSmith India as well, the distribution day count is at 1. And therefore, I think as numbers start improving in Q3, Q2 will always be a little bit soft because of the monsoons and the seasonal weak quarter that is always expected. But commentaries might hint to better numbers coming through Q3 onwards, which will give the much needed impetus for the markets. And in all probabilities, if we remain in a confirmed uptrend, we might actually hit all-time highs before we end this campaign.
All right, that's the take on coming in on select consumption names. But the next gen GST reforms are transformational. Those are the words coming in from ITC CMD Sanjeev Puri in an exclusive chat with ET Now. He adds that this move will boost consumption, employment, and drive economic growth. Listen in.
Transformative reform. It's going to make good quality products accessible. Prices will go down. For every consumer, there will be a lot of savings for consumers. I think we should all celebrate that. And it's also, backed up by simplification that will improve the ease of doing business. And at ITC, we are all committed to passing on all the benefits to the consumer.
Sir, can GST 2.2 spark a new cycle of demand in the economy?
Yes, absolutely. It's going to fuel consumption and therefore investments and leading to employment. So it's going to set in place a virtuous cycle.
So it's a start of the festive season as well. So how this move is going to positively impacting the overall demand cycle?
It will be very positive. It will be very positive, and I congratulate the Honorable Prime Minister for his vision and direction to get this being done, because it's truly transformative and it's going to have very significant positive impact on the economy.
Okay, that was the exclusive word coming in from ITC Sanjeev Puri, but we also caught up with Sanjeev Mehta, the executive chairman of El Catterton India and former chairman and CEO at HUL, and he shared his views on the GST rate rationalization and how he believes it will aid consumption and premiumization. Let's listen in.
There are no categories in India which are anywhere close to maturity. You can get growth by increasing penetration or getting more consumers. You can get growth by increasing consumption, and you can get growth by premiumization. Now, premiumization has been a secular trend. We must remember that India for the last 30 years has been growing at a CAGR of 6.5%. And if you look at the nominal growth, it has been growing at about 10-11%. So you have more income, and certainly more income at the top of pyramid, and everyone wants higher order benefits. So premiumization as a trend will continue for years to come. Yeah? But increasingly, when you have more income in the hands of people, the consumer's behavior also changes. To give you some insights, when times are tough, in households at the bottom of pyramid, they would have one toothpaste or one bar of soap in the bathroom for all the family members. When things become better, when things become more affordable, when the incomes go up, they would be having a bar of soap for every member of the family as per their choice. Similarly, it goes with the toothpaste. So it does lead to more consumption. And I think the government has done a fabulous job of bringing down the rate of most of the items to 5%, which should give a fillip to consumption. There is no doubt about that.
Indeed, GST is expected to give a fillip to the consumption, but let's hear out from the corporate itself. What does this GST reset mean for the growth ahead? We spoke with the management of BKG as well as GCPL. Let's hear them out.
This simplification in tax structure overall will help in doing ease of business in India across. And as a business, as a brand, we are committed to pass on completely. Like in family pack, we serve a 2-pack, family and impulse pack. So all the bigger pack will have reduced MRP from today. So we'll be passing on completely to the consumers. So overall, from margin lens, we don't see any major improvement due to GST cut. But yeah, overall, we see good volume growth coming in after GST cut, because as rightly said, we see organized sector going more stronger in future. And that will help all the organized industry.
About 35 to 40% of the portfolio is impacted by GST, which is not a bad thing, because after a certain point you get into an inverted duty problem, which 35 to 40 is a good amount to be at 5%. I think the category growth will inch up by a couple of percent, but it will not inch up. It will not go up by 11%, which is the extent of price drops that all of us are giving in GST. It's very hard for us to judge what's going to happen in Q2, because these are unprecedented transitions. And often there are all sorts of issues that go on in transition. So it's very hard for me to predict what will happen in Q2. We'll only know in the next 8 to 10 days. But I think chances are things will be volatile. Which way, I don't know, but they'll certainly be volatile. Going into Q3, we are quite bullish, because GST is a fillip. And you must remember that last year in Q3, probably driven by food inflation, FMCG and consumption in general had a tough time. So you're really coming off a tough quarter and you're going into a good quarter. So I think all of us are really hopeful about Q3.
Okay, so that's the word coming in from the managements of BKG and Godrej Consumer Products. So Mayurish, taking this GST conversation ahead, we've been talking to a lot of white code managements and consumer durable companies, and they're optimistic that this GST cut could make up for the kind of losses they've seen due to the early monsoons. Do you think that is something that could be possible, or how long do you think GST benefits would take to start showing up as positives in the company financials?
I think most managements are alluding to the fact that an evident volume picture will be only visible in Q3. And thereafter, I think it all really depends on how the demand dynamics stick up. Having said that, I think in terms of consumer durables, and structurally, I think if you really look at white goods as a segment, they're talking about ACs, refrigerators, washing machines, microwaves as an example. I think that entire ecosystem might see some element of growth coming through. And that might be prima facie in terms of urban and semi-urban areas, where a large part of this growth will come through. The income tax rationalization, which has happened, which will again start paying out very, very effectively with GST rationalization coming through. I think there will be an added incentive to probably go out there and spend. And therefore, I think a lot of management seem very, very optimistic. And therefore, I think visible results will only be seen probably in Q3. Having said that, I think the expectation largely in terms of how much of an impact can it create in terms of volumes and therefore all our numbers when it comes to top line, including margin expansion and bottom line growth. I think Q3 will be a base factor. Having said that, again, I think Blue Star is something from the AC segment which is done well. A proxy to this might also become something like an Havels, which can probably have some element of say, both in terms of durables as well as creating the necessary impetus that it probably carries through in terms of its core business.
All right, so that's the take coming in on select white good companies. But along with that, Richard, just wanted to have your take on select tire counters, because today morning we were speaking with the management of CEAT where they were quite optimistic about the demand going ahead, not just the replacement but also from the OEM side. That's expected to do well. And all in all, in this auto rally, the tire counters haven't participated much. But Ruchit, amongst Apollo Tyres, CEAT, Balakrishna Industries, if I ask you to pick one, what will that be?
Yes, I think the segment as a whole, if anyone is looking for some positional picks, then one can look for tire sector where overall structure seems to be positive in some of these names. But if I have to pick one amongst these, then Apollo Tyre would be preferred one. The stock has recently seen a price up and a breakout above its immediate hurdles, which was around 460, 470. And if you look at the price structure, that then is the formation, higher top, higher bottom formation, along with the rising volumes. The stock is even not breaking its 50-day exponential moving average support if you look at recent short-term charts. So overall, I think this space should do well, and within this, Apollo Tyres in terms of risk-reward ratio is much favorable over here. So one can look to create fresh longs on Apollo Tyres at current levels.
So Apollo Tyres looking good, and create fresh logs is the word coming in from Richard. But Kunal, we also spoke with the management of JK Cement early in the morning today. What's your take on some of the cement counters? Because GST has also significantly reduced on that pack, but your pecking order amid that space?
So it's a space which has done just okayish, I would say, on the price recovery front. Even for JK Cement, for example, in the last 4-5 days, we've seen a pickup of 300-400 points, which is largely 3%, 4%. In the stock price movement. So I think in that sense, from 6,400, it's moved towards 6,800, 6,850 mark. Mild recovery coming back into the likes of ACC, Ambuja Cement. So maybe I think it's just about a very tepid rally. Difficult to pinpoint the outperformers or the outliers over here, because as of now, we are still into a phase where the sector is going through a very tepid recovery. Maybe I think Grasim, you can also look at Ultratech Cement. These are the two names which have generally been leaders or strong performers in terms of the cement pack. So maybe I think these stocks could be better placed with respect to the other players.
All right, so that's the take coming in on the cement counters. Let's watch out for that. But along with that, on the bottom of your screen, you will get to see that it has SEBI that has issued a consultation paper on technical glitches in the stockbroker trading system. The framework, first issued in November 2022, is now under review after the industry feedback and the circular to take effect from November 1st, 2025. That's the big news that we are getting to understand from the SEBI front. It's a new consultation paper that has been issued with respect to the technical glitches, but this is applicable on the brokers who have 10,000 or more clients as of now. But along with that, Mayuresh, just wanted to have your take on select exchange-related counters. Of late, they have been very volatile on the back of the kind of news flow and the F&O adjustments, how the volumes are expected to get a hit. But what's your sense on the exchange-related counters as of now, Mayuresh?
So, I think you'll have to give it time, right? Because I think with all the regulatory changes that are now transpiring as we speak, it really depends, and it's to be seen what kind of an impact does that really have in terms of the overall volumes as far as these exchanges are concerned, both BSE and the data that we'll get from NSE as well. And therefore, I think equity-linked exchanges might actually have some element of softness embedded in Q2 based on all these factors put together. And what does the consultation paper actually tell us in terms of weekly expiries, whether it's going to be fortnightly expiries looking forward? I think nobody's sure about that. So I think wait and watch on that. In fact, out of the exchanges, MCX in terms of ratings and rankings probably looks a little bit better placed. The expectation in terms of more contracts coming through MCX way might actually pave way for more stability in earnings as we speak. The gold and the silver futures, which have probably got launched, options, which is still a large part in terms of the average daily turnover. The balance sheet probably looks very, very strong. They've got very strong EBITDA margins as we speak, in excess of 70, 71%. And therefore, I think more institutional participation as one reads through in terms of the commodity exchange, the kind of leadership that this stock probably carries as far as a large part of the contracts are concerned, whether it's gold, silver, crude, natural gas, which becomes a more important and a prominent part in terms of their average daily volumes, might actually mean that if all these initiatives are taken up, it might mean better volumes and margins would probably sustain, which means better bottom line growth. So out of all the exchanges at this juncture, MCX probably seems to be a tad bit better place.
Indeed, and off late, the stock has been seeing decent moves as well. But Kunal, there's been no stopping in the gold and the silver prices as well. MCX is indeed one of the beneficiaries, but one of the other pockets is the gold financiers companies. No stopping on that front as well. Take a look at Manappuram and Muthoot. Even on this day, the stocks are doing so very well. What's your take on that, Kunal? How much more headroom is there?
Yeah, I think till time the gold prices they keep on rising up higher, I would believe that there could be a chance that the gold financiers they could stand to outperform. And even on the dollar terms, for example, for the gold prices, I don't see a major cool off happening at least as of now. My expectation is that I think we should at least come close to that $4,000 per ounce mark, or maybe break past about those levels on the gold prices. So maybe I think in that context there should be some upside left for the gold prices over the short term. So yeah, even from a short term angle, the likes of Manappuram Finance, etc., they would be considered more as a buy on dips approach.
All right, buy on dips could be the strategy when it comes to gold finances. But Ruchit, if I can have your closing comments, the kind of closing that we are getting to see, Nifty 50 is exactly at that 25,200 mark, while for Nifty Bank as well, 152 points of decline. Where do you see the markets open for tomorrow? What's your analysis there?
So I think considering that last half an hour or last 1 hour we have seen some selling pressure, we could see a soft opening in follow-up move tomorrow. But definitely, if we get some kind of negative opening towards that 25,100, if comes, then that such a kind of negative opening could then be used as a buying opportunity. So price-wise downside seems to be limited from here on. I think it's just that time correction could happen in tomorrow's trading session. So some consolidation could be expected.
Out for that. But with this, Mayuresh, Ruchit as well as Kunal, thank you so much for taking the time out and speaking with us. Just a few minutes left for the market to shut shop, and let me hand over to Snehi to tell us how did the markets pan out today. Snehi.
Well, absolutely, Shrishti. Let's take a look at the kind of tumultuous moves that we've seen in today's trading session. Very marginal recovery coming in from the day's low. If you take a look at the Nifty 50 intraday move, 25,205. Looks like we might just close above 25,200, but still a minute and a half left. So let's see what happens on that front. But nonetheless, a 0.5% cut coming on the Nifty 50, 0.5% cut coming on the Sensex as well. Nifty Bank has done slightly better than the benchmarks, but still a 0.3% cut coming in on the Nifty Bank as well. It's actually the broader end of the market that's marred farther. 0.6% cut coming in on the mid-cap space, and more than a percent cut coming in on the small-cap space, which has continued to be the outperformer for quite a few sessions in the past, but that has reversed entirely today. In terms of the Nifty gainers and losers, all eyes were on the Adani Group of stocks today. Adani Enterprises, your top Nifty gainer. Even other than that, Adani Power, Adani Ports, Adani Green Energy, Adani Total, all of these stocks have done very well for themselves. Eternal, Bajaj Finance, Ultratech, Adani Ports, Bajaj Auto, Axis Bank, these are your top Nifty gainers. On the flip side, pressure persists on Tech Mahindra, TCS, Infosys, Wipro, HCL Tech, your top 5, top 50 Nifty 50 losers. And that's the take on the entire IT space. That H1B visa fee has still kept the sector sentiment quite negative, and the IT space is the biggest loser in today's trade. Almost a 3% cut coming in on Nifty IT the intraday. Other than that, energy, media, metal managed to hold on to some gains. Hindustan Copper did very well for itself, up 5%. Realty, bank, PSU banks, FMCG, Pharma have shut shop in the red. So that is what the market texture has been like today. We'll give those rates some time to settle exactly around the 25,200 mark. That's how we've shut shop for the day.
In association with SBI, best है सबको पता है.
GK Energy Limited launches an initial public offer of equity shares of face value of 2 rupees each in the price band of 145 rupees to 153 rupees per equity share. Bid offer opens on Friday, September 19, 2025. Closing